Here's the part that should bother you. 2024 was a good year. The market handed everyone a 25% gain, one of the best bull runs in a decade, and the average investor still managed to leave nearly 9% of that on the table. Not because of bad luck, not because of bad stocks, because of bad behavior. That's not a one-time thing either. According to Dalbar's annual investor behavior study, 2024 extended a 15-year losing streak. The last time the average equity investor beat the S&P 500 was 2009. 15 years. That means an entire generation of investors has come of age, learned about stocks, opened accounts, started contributing, and has systematically underperformed a fund that does absolutely nothing but hold every stock in the market and wait. So the question is, why? What's the hand they keep playing wrong? That's what we're here to figure out. Welcome to flush draw. In poker, a flush draw is when you've got 4 cards of the same suit. You're close to something powerful, but you haven't made your hand yet. Most players in that spot get impatient. They overplay it. They shove all in, chasing a card that may never come. Sound familiar? This channel exists because the stock market is not that different from a poker table. There are players with better information. There are behavioral traps that bleed you out slowly. And there are structural edges that some players hold and most people never even see. We read financial news and market research so you don't have to read it blind. We curate the data, cut through the noise, and give you our honest take on what it means for your money. Today's hand, the 4 forces that make most investors lose and how to recognize them before they cost you another 15 years. Let's get into it. The first force working against you doesn't live on Wall Street. It lives between your ears. Let me give you a poker analogy. Imagine you're sitting at a cash game. You've been running well, 3 winning sessions in a row. You start feeling like you figured it out. You start calling hands you should fold. You start betting into pots you have no business being in. That's not skill. That's overconfidence bias. Now put that same mental wiring into a brokerage account. According to research from FINRA, 64% of investors believe they have a high level of investment knowledge. Meanwhile, the actual data shows that over a 20-year period, the average retail investor earned just 2.6% annually, while the S&P 500 returned 7.8%. That's not a knowledge gap. That's a canyon. But overconfidence is just one trap. Behavioral finance researchers have cataloged a whole stack of cognitive biases that eat your returns. Here are the 3 that do the most damage. Loss aversion. Nobel Prize-winning research from Daniel Kahneman and Amos Tversky found that losing money is psychologically twice as painful as gaining the same amount is pleasurable. That asymmetry wrecks your decision-making. It makes you hold losers too long. You can't bear to book that loss and make it real. And it makes you sell winners too early. You lock in a modest gain because you're terrified of giving it back. Herd mentality. This one is brutal because it feels like wisdom in the moment. Everyone is buying. The news is bullish. Your coworker just told you about a hot tip. Research shows that just 5% of informed investors can drag the other 95% of the market along with them. So you pile in, usually near the top. Then the sentiment flips, and you're the one selling the lows. Recency bias. Whatever just happened, you believe it will keep happening. 3 straight years of bull market? Obviously, stocks only go up. 1 bad quarter? Obviously, we're heading to recession. Both conclusions are usually wrong. The market's best days and worst days are often separated by hours, not weeks. Here's the punchline. The Dalbar study found that withdrawals from equity funds happened in every single quarter of 2024. And the largest outflows hit just before the market's biggest surges of the year. People were literally selling the bottom, not because the fundamentals changed, because their brain told them to fold a winning hand. That's force number 1. You're not just playing the market, you're playing against your own psychology. And until you understand that, the rest of this doesn't matter. Okay, so we've covered the internal game, the fight against your own brain. Now let's talk about the external game. Because even if you've mastered your emotions, you're still sitting at a table with players who have information and infrastructure you simply don't have access to. In poker, if your opponent can see your hole cards, it doesn't matter how disciplined your play is. You're going to bleed chips. Let's be specific about what this looks like. High-frequency trading firms now execute orders in microseconds, millionths of a second. These aren't traders. These are algorithms, co-located inside the same data centers as the exchanges themselves, shaving fractions of a cent off every transaction. At scale, those fractions add up to billions. And some of that cost, however small per trade, flows from retail investors to the infrastructure of these firms. Now, I want to be fair here. This is a genuinely contested point. Some researchers argue HFT improves market liquidity and tightens bid-ask spreads, which benefits everyone. That's a real argument with real data behind it. The Investopedia research on algorithmic trading does note that HFT creates market efficiencies, including lower transaction costs for retail investors. But here's where I land on this. The structural informational asymmetry matters more than the HFT debate. The bigger issue is what happens when markets get volatile. When things get chaotic, a surprise rate hike, a geopolitical shock, a sudden earnings miss, institutional players don't just absorb the volatility. They widen their spreads. They step back from the market. They let the price action run. And retail investors, who are reacting emotionally and don't understand what's happening mechanically, are the ones trading into that vacuum, often at the worst possible prices. My read on this? The deck isn't completely stacked against you, but pretending the table is perfectly fair is how you get taken by surprise. Knowing the structural reality means you stop trying to compete in the short-term game, and you position yourself on the longer-term game where these advantages erode. That's the edge retail investors actually have: time. And most of them throw it away, trying to trade like people who do this with server farms and PhD quants. This one is probably the most counterintuitive thing I'll tell you today, and it has massive implications for how you think about stock picking. Here's the stat. According to research by Arizona State University finance professor Hendrik Bessembinder, who analyzed every U.S. common stock traded since 1926, over 25,000 stocks across nearly a century, just 4% of stocks were responsible for all the net wealth creation in the U.S. equity market. The other 96%? In aggregate, they performed no better than Treasury bills. Dead weight. That's not a glitch in the study. That's a structural feature of how stock market returns are distributed. They're wildly skewed. The winners, Apple, Microsoft, Amazon, Nvidia, generate returns so enormous that they pull the entire average up. The losers, and there are thousands of them, cancel each other out or erode into nothing. Think about what this means if you're picking individual stocks. You are not looking for a coin flip. You are playing a game where 96 out of 100 cards in the deck are losers, and 4 of them are where all the money is. If you happen to be concentrated in the right 4 stocks, you look like a genius. If you're in the other 96, which statistically you probably are, you're underperforming T-bills. Now, the professional actively managed fund industry is supposed to solve this problem. They employ armies of analysts to find those 4%. So, how are they doing? According to the SPIVA year-end 2025 scorecard from S&P Dow Jones Indices, 79% of all actively managed large-cap U.S. equity funds underperformed the S&P 500 last year. And that's not an anomaly. Over the past 10 to 20 years, between 85% and 93% of active funds trail the index. So let's be real. If the professional pickers, with billions of dollars, proprietary research, and full-time analysts, can't consistently identify the winning 4%, what makes the average retail investor think they can do it scrolling through Reddit and watching earnings calls? This is not me saying you should never research individual stocks. This is me saying, understand the game you're actually playing before you sit down at the table. The concentration problem is real, and it's why index-based strategies have been so dominant over the long arc. We've covered psychology, structural disadvantages, and the concentration of returns. The last force ties them all together, and it has the most devastating numbers: market timing. Every time a retail investor sells during a downturn, hoping to avoid more pain and buy back in cheaper, they're taking an enormous risk. Not just the risk of being wrong about direction, the risk of missing the few best days that drive nearly all the gains. Here's the data from Hartford Funds, which analyzed S&P 500 returns over a 30-year period. If you stayed fully invested, you just held, your returns were strong. If you missed just the 10 best days of that entire 30-year span, your returns were cut in half. Missed the best 30 days? Down 84%. And here's the cruel twist. 76% of the stock market's best days, those rare, explosive upswings, occur during bear markets or in the first 2 months of a bull market recovery. Meaning the worst time to be out of the market is exactly when everyone most wants to be out of the market. The Dalbar 2025 report confirmed this with brutal precision. Investors pulled money from equity funds in every quarter of 2024, and the largest withdrawals happened just before the market's strongest rallies of the year. They folded the best hand they were dealt. In poker, there's a concept called fancy play syndrome, when a player is so eager to make a brilliant, creative move that they talk themselves out of the simple, correct one. They're sitting with a flush. They know they have the best hand, but they try to slow play it. They let their opponent check back, and they end up winning less than they should have. Market timing is retail investors' version of fancy play syndrome. The simple, correct hand. Stay invested, own the index, let compounding do its work is boring. But boredom compounds. Cleverness costs. So let's put this hand together. 4 forces are working against most investors: their own psychology, overconfidence, loss aversion, herd mentality, recency bias. Structural asymmetry. The market isn't rigged, but it's not flat either. Institutions have information and infrastructure that retail traders can't match in the short term. The concentration problem. 96% of individual stocks don't beat T-bills over their lifetimes, and professional pickers can't reliably find the 4% that do. And market timing. The fancy play that bleeds you every time you think you're being clever. None of this means you can't win. It means you have to know which game you're actually playing. The investors who've beaten these 4 forces over the long run aren't the brilliant stock pickers. They're the disciplined ones. The ones who understood the table, picked their spot, and had the patience to let the hand play out. That's the edge that's actually available to retail investors. It's not exciting. There's no flashy move, but it works. If this kind of thinking resonates, cutting through the noise to read the actual hand being played in markets, hit subscribe. We cover financial news, market analysis, and investing fundamentals every week with this lens. Next video, we're going inside the Federal Reserve's interest rate game, specifically why rate decisions almost never do what the market expects them to do, and how to position around them without guessing. That one drops next week, and it's a good one. Until next time, know your hand,